Now, when we look at some of the higher level financial ratios that the chapter covers, we won't go over the ratios, but I'll go over the structure of the balance sheet. So at a high level, a balance sheet is just broken down between your assets and then the liabilities and equities, and then they break it down by the length of the time. So you've got current and long term. So current assets and liabilities are important because they represent the working capital of a firm. And this is essentially assessing the short-term health of the company, their ability to pay their financial obligations over the next 12 months. If something is longer than 12 months, then it would be classified as long-term. And long-term assets are capital expenditures. And that's what we are going to be talking about in this chapter, the analysis of how to make that investment. Long-term liabilities is debt, things like bank loans, bonds, and shareholders' equity, as most people know, it's going to be your common shares plus retained earnings. And retained earnings is all of the money that the company has earned since it started. Okay, so this is what we will be talking about in this chapter. How do you assess what capital expenditure decisions to make? And there's several different methods that the book talks about, and we will go over each of them. Most of them are cash flow, except for the first one. So the first one is called the average accounting return. And this is the only one that is not cash flow based. So as this sounds like, this is an accounting based method. Okay, so they're analyzing the project based on its net income. The other ones are the payback period and discounted payback period. And then you have, probably the most commonly used one is the NPV, or the net present value. And then we won't calculate this one, but you should understand what it is. It's the internal rate of return. And the last one is the profitability index. Okay, and if I break these down, these are all cash flow based, and they will consider incremental cash flows when analyzing whether you should make an investment or not.